Hello, everyone, and welcome to today's event, Demystifying Venture Capital. It's part of the WIN Fellowship Initiative at the Atlantic Council. The fellowship aims to supporting women entrepreneurs across the Middle East and North Africa region, and at fostering an environment conducive to their growth. I first want to thank our sponsor, PepsiCo, and the U.S. Embassies in Saudi Arabia, UAE, and Bahrain. In the MENA region, less than 5% of businesses are led by women. And many of these women entrepreneurs, they do not actually seek formal financing. They rely a lot on their personal saving, a lot of family support included. This is why we see 66% of women founders, they believe that investors are less inclined to invest in startups led by women, a perception supported by the fact that as of September 2022, only 1% of the total of $374 billion invested in the Middle East went to companies founded or co-founded by women. That's 1% of $374 million. So women entrepreneurs in the region, this is why they're reluctant to approach VCs, venture capitals, largely due to the lack of trust and transparency in the VC ecosystem. This is rooted in several factors. One, the venture capital landscape in the region is relatively new. There can be lack of clear and accessible information about how these funding mechanisms work. The second one is the cultural and societal norms in the region. Sometimes they create an environment where business dealing are less regulated, which leads to concerns about how fair they are, and especially in the VC world. And women entrepreneurs then are fear approaching VCs. So the absence of a strong track record of successful women-led venture funded by VC in the region can also contribute to this hesitation. Without visible and relatable success stories, women entrepreneurs may doubt the willingness of VCs to invest in businesses led by women and creating a huge trust gap. The situation is also compounded by the fact that globally and in the MENA region, the VC world is predominantly male. This gender imbalance can make it intimidating for women to pitch their businesses and negotiate terms. So today, we're going to take all of that and we're going to discuss it all. We will delve into the venture capital ecosystem, that will clarify processes, opportunities, especially for women in the Middle East and North Africa, and we'll break down these barriers with open conversation from actually leading experts in the region. But first, let me introduce you to the moderator of the session, our own Amjad Ahmad. He's the chairman of the Empower Me initiative at the Atlantic Council and a managing partner at 500 Global. With over 2 decades of investing in emerging market, Amjad facilitated over $1 billion in venture and growth financing across the Middle East, North Africa, Pakistan, and Turkey, spanning on different sectors as well. Amjad, thank you so much. The floor is yours. Muted.
Oh, sorry. Thanks, Lynn, and thank you, everyone, for joining us. Rather than read their extensive bios, which you can find in our event details, and given that I know both of our speakers intimately, I'll introduce them based on what I know. They are not only great investors and thoughtful advisors to their founders, but they're also generous and deeply care about improving the economies of the Middle East. First, Amal Dukhan is a general partner with 500 Global based in Riyadh, Saudi Arabia. She's an astute investor with deep knowledge of the Saudi market and cares deeply about helping founders develop outstanding companies in the kingdom and beyond. She's also passionate about building the Saudi VC venture ecosystem and has strongly advocated for the industry since its founding. Welcome, Amal, and thank you for being here with us.
Thank you so much for having me today. It's an honor and it's a pleasure, and can't wait to actually hear the questions. It's a pleasure. Thank you.
Great. Next is Tamer Kadumi, co-founder and general partner with Venture Souk, based in Dubai, UAE. Tamer's intellect and rigorous approach to understanding businesses make him an ideal partner for early stage founders and a thoughtful partner to invest alongside. And I can tell you that personally. He has raised awareness of venture capital in the Middle East for over 10 years and has built a wonderful firm supporting early stage founders. Welcome, Tamer, and we appreciate you being with us as well. You're muted.
Yeah, thank you. I was just going to say that flattery goes a long way with me. So I'll do it.
Okay, so look, I wanted to jump into this discussion by first laying out the landscape of what is venture capital and how you think about it, and then what your particular firm or your particular investment approach is in venture today. We know there's a lot of different funds, but it'd be good for the audience to understand your particular criteria and investment mandate. So, Ahmed, why don't we start with you? You know, if you had to explain venture to my 13-year-old daughter, what would you say?
You know, I've done this before where I explained it to students in school, so it's not so alien for me. And literally, it's about getting money from people that trusted you so you can invest on their behalf to start with, you know, be it individuals, be it institutional, be it fund of funds, government money. So I think one thing to note in institutional funds, the most common, you know, kind of notion, you'll know that most of the people are actually, you'll find some single GPs, but it's not super common here in the region. You'll find that these are institutional VCs that invest on behalf of others. So that's a very important point to actually note. It's high risk capital, you know, that goes to high risk companies, meaning this is the type of cash, you know, that people want to put, knowing that this is not going to give fast returns. It's going to probably stay for more than 5 or 10 years until it brings that return to you. And it has to include, if it's venture capital, a technology element into it, right? And that's how we actually invest in 500, where we look into companies that has a technology element at the core of it that actually includes a team where the technical team is in-house, and basically, you know, the whole team is building for the long term, you know, of the life of this company to bring returns, hopefully, to the LPs and to the GPs of the fund. So I think it's very important to know the alignment of interest. And sometimes I say every fund has its own interest. Sometimes it's sectorial, sometimes it's open. So understanding really the structure and what they invest in is the first homework that any founder should do before going, you know, and really understanding about VCs. And the second thing, in understanding, you know, how the capital works. So one of the things that we might be talking about is the cap table, and it's important, even at the very early stage, whom to get the money, whose money will come into the company, and that type of money that went in, it will get you to what stage. So it's kind of sliced in many ways. So it's not the money I need for the rest of the life of the company if you go with the venture capital route. So much to be said, obviously, into that. But I think we also come into the pre-seed and seed, so high risk stages. Our belief mainly relies on the experience of the founders at this early stage of pre-seed and seed. And because we run an accelerator piece as well as part of the fund, so there is also that kind of extra support that comes and value that comes with the money as well. So we kind of run this model, you know, in a way where we invest first and then onboard to the accelerator. And that differentiates us as well from other accelerators that are in the region. So we're by nature very, you know, support driven, very, you know, kind of involved hands in hands, you know, with the founders, and even in connectivity to other investors as well. And I believe we will talk more and more. But again, it's the business of high risk cash. So when you pitch that idea, you probably need to understand, you know, why people would go all the way in questioning, you know, what you're offering, because they're investing on behalf of others and they're looking for multipliers that are more than just few X's, right? So that's, I think.
Before we move to time, and just to clarify for the audience, you know, you mentioned the word accelerator. How does an accelerator differ than just going to an investor and just getting money? What does the accelerator provide?
Yeah, that's a good question. So the accelerator piece, Basically, it's about assessing the stage that we're coming into the company at the very early stage, at least guaranteeing that the people in place, whether it be it, one founder, another technology and CTO, that's the minimum you would want to see in, a tech company with an experience in the sector. And the accelerator takes you from the journey of, let's say, having initial kind of customers, very initial minimum viable product, which is your initial product that barely works with the initial clients that you have, to prove that this problem exists, right? So every founder needs to actually solve a problem, and that actually goes a long way even later on when you pitch to an investor. But if there is a fit for that problem in a certain market with a certain consumer, then we are able to work with you on the accelerator. So what we do, we measure what is the next milestones you need to achieve, be it hiring other people in the team. But we mainly focus on growth, to tell you the truth. Our goal is to prove that this model can be repeatable and it can grow with time. And if we inject that cash, where would it take that company? It's like an experiment from point A to point B, which is the 12 weeks program. The way we say it's an accelerator because you get the support of mentors. I think the core value of the program, we get technical mentors and we get, growth hackers, we get whatever we need for the type of company. So we customize the mentorship based on the companies that we have in the program. And we know for sure, we assess the acceptance of the companies in the program, whether they will benefit or not. If they're not fit to the program that we were not able, if we're not able to take them and grow them from one stage and support them from one stage to another, then it will not be fit. But one important note, I get asked a lot, so you do the marketing for us, so you do, no, we don't do anything for you. What we will do merely is have people that might be investors, that might be developers, that might be, anyone who's an expert in that market, a regulator where you want to understand the regulatory scheme, right, in that market. And they will help you understand really what's happening, in that market. And we support you to go from that one step to the next milestone while you are in that support ecosystem for 12 weeks. The journey does not end. And every investor, like Amjad mentioned about Tamer, it doesn't end by your investment. It doesn't end by the accelerator. It ends with a demo day with us as a first phase. But then later on, the relationship continues, updates, supporting to introductions to investors, finding who's the right investor, right? Access to other market, benchmarkings to international companies. So it's a partnership. When you're selecting your investor, you're selecting a partner for the life of the company and hopefully beyond when you exit and come back for the next company, right? But the accelerator is literally, think of it as a compressed time that pushes you to achieve certain results under high pressure with a community. So I think that's what we hear with most of the founders, that I suddenly found people that are going through the same stage at the same time, where we're able to talk about things that we cannot talk about to our families, we cannot talk about to our friends, and then we have these bonds that gets connected. And the best supporter to other founders is a founder. They connect, they introduce, they give advice. So it's quite an interesting, actually, environment to be in.
Perfect. Thank you for that. And Tamer, now to you. What is venture and where do you sit within that venture landscape?
Well, I think that Emil can basically teach a masterclass on this. I think one thing Amjad and I can just go away, and Emil, you just run with it. Honestly, it's really, I think your experience is very broad, and so it covers a big swath. The one thing that I want to add is that, and it would maybe preempt everything that Emil said, is to say that not every company is venture capital is not the only type of is not the only category of capital. There's lots of different formats of money that can be accessed in many different ways. And so it's kind of first you should determine, is it appropriate for you to be raising venture capital? Is venture capital the best thing for you? It's not am I good enough to get venture capital? It's is venture capital good enough for you? Or is it appropriate for what you're trying to do? And if I want to, and so on that, I think there's three, this is me shooting from the hip, but I think there's kind of three criteria that you would want to ask yourself prior to going and seeking venture capital. And that's the type of companies that it's appropriate for. Number one, it's companies that intend to scale, right? That intend to go from a small size and to grow really quickly and to kind of decouple from their basic costs into in cut across many different markets and many different people. And inherently, those venture backed companies have typically like demonstrate one of three qualities. They offer a service at lower cost, they offer a service at more convenience, or they offer a service that's better quality. And all three of those come at the expense of margin. And so, and in order to make up for the inherently lower margin, you need to sell to a very large number of people. So you first question is like, do I want to take this company and sell it to a huge number of people? And that brings me to like sort of criteria number two. Criteria number two is like most venture companies require a heavy investment of time and effort upfront prior to monetizing, prior to like selling their widget or their service to people. You're building a product typically, and that requires a lot of upfront effort in advance of sales. And so as opposed to potentially being a services company where, okay, I can start offering, graphic design services or consulting, engineering services to somebody in exchange for my time, or I can trade, I can buy something and add a little something to it and repackage it and sell it. And so you can sort of make money really upfront and therefore potentially fund the business yourself. Most venture-backed companies require a certain like upfront investment of time and effort that you would want to like finance with someone who's kind of like taking a risk on the business. And then the third characteristic Emil alluded to, almost all venture-backed companies are built around technology or incorporating technology in a big way. And that's like sort of reinforces points 1 and 2. If it's going to scale, you need to automate a lot of stuff. And so there needs to be tech, and tech is going to be a big part of the upfront expense. And so, but point number 3, you need to incorporate technology in a big way. And a lot of times these businesses, like really what is super valuable about the business is the technology itself. So, I mean, it's kind of like answer those 3 questions. Am I doing one of those? Am I building a company like that? And because if it's not, then maybe venture capital is not the like most appropriate, or it's not the best. It is expensive, right? It's like you're going into partnership, whether those equity investors come at the earliest stages that Emil was alluding to, so like at the accelerator stage or at the seed stage, and then in that nomenclature, which seed, Series A, Series B, Series C. This represents a trajectory whereby you're funding your company as the company evolves with more money. There's like a sequence of these funding rounds that you'll need to raise. But perhaps if you are doing you're building a business that doesn't fit those criteria, look, you can fund it yourself, or you can go and raise a different type of money from a different type of investor, or you can go to a bank and the bank will finance you. And then in that case, it's like, a bank is a pretty good value proposition for a business. Give me money, I'll use your capital in order to build my business. Once my business is up and running, I'll just pay you back your money plus interest, as opposed to a venture capital company or a collection of venture capital firms that are invested in, or angel investors who you're stuck with them for life, so they can add a lot of value. And I think that in most of the time, and most of the people that we work with have the right intentions in mind. But hey, this is all a long-winded way of saying it's not necessarily that venture capital is the right way to do it. You should look at the company and say, am I likely to be is this likely to be the most appropriate form of financing for me? So I think that's everything else. Emil sort of like hit the tail on the donkey.
Right. I'll just add one more thing to what you said, which is it's good to know also, when you're approaching venture capital funds, what they want to invest in, because some of them, some of you don't have tech businesses or might not have tech businesses. There are venture capital firms that do non-tech, but you'll have to find those particular firms. Most VCs are tech oriented. That's the reality. And I would say in the region more so than the options globally. Tamer, just to push that to the next step. So when you think about VentureSouk and yourself as a partner, when you're out there scouting and looking for deals, what are those things that you're looking for in an investment? You mentioned what they should be thinking about when they're looking for venture, whether venture is the right approach. what are you looking for? So what are the boxes that they would need to take off for you to make it attractive?
Yeah. And I think answering that question actually, like, it harkens another point that should be noted by everyone. There are very few investors, present company included, Emil and myself, who like it's all our money that's going into this, right? We have an agenda. We have a business model that we run. We have customers. We have, investors that are behind us that we need to build we need to sort of like make a pitch to them. Hey, give us money for a specific reason. And here's why here's why you should give me that money and not necessarily someone else. And here's why you should give me that money and not do it yourself, right? Here's what I can do to help you. And so there's a business model that I'm running, and there's stakeholders that I have to answer to. It's not, I think a lot of times you'll go, okay, all right, venture is the right form of financing for me. And so let me go and start with angel investors and then accelerators and then venture capital firms. And you get into this sort of presumption that the person that I'm asking, or the person that I'm pitching to, is making a determination about me, or is making a determination about whether he or she likes me, or whether he or she likes my, thinks that I'm, got a future or not. Oftentimes what the person that you're talking to is doing is solving for the constraints that he or she is doing, is managing in their own business. And so to answer Amjad's question, it's like, what we will have done, VentureSouk in this example, we will have pitched to investors, to us, hey, we think that, like, fintech in the MENA region, so from Morocco all the way to Pakistan, we think in that region, fintech is going to go through some major inflection point. And so we're going to be looking for companies that we think will be able to have a big impact, commercial impact, be able to service sell to a lot of people. A lot of people are going to find what they're doing to be helpful or attractive or useful. And we're going to find a bunch of those, and we're going to back those. So you give us the money, we'll find you 25 or 30 of these guys that are going to that are going to have these biggest, highest impact fintech companies in the region that we've delineated. That's what we pitch to them. So like the first question is, what do we look for? We look for companies that fit the criteria that we ourselves have sold to our investors. We are constrained. If you don't fit within the thesis that our company has, then we're not going to be able to invest into the company no matter how good you are. And so I think that, and Amjad alluded to this point, which is like, the first question is like, is the person that I'm talking to, do they have a history, or have they communicated a thesis that they do the thing that I'm doing? But if they haven't, then it could be, okay, maybe you want to meet them just to meet them, and maybe they can be helpful, but it's not going to be the hardest hitting. It's not your highest probability of the chance of convergence, right? But step number one is like, are you on the fairway for what that investor actually does, right? And so, like, let me pause there, because I think there's many more ways that you can answer that question. Now, if we've established that we are on that fairway, what are the things that we look for? What are the sort of like criteria that we use to identify what is good and what's not? But let me pause and offer to pass it to Emil, and then I guess we can, if you want to go in that direction, Amjad, we can keep on riffing on this subject.
No, for sure. I think just to help our audience as well, I think there are a few ways that you can go about this, right? One is, funds are very transparent about their criteria on their websites, because they want to do that filter, right? They want that stage one filter, because they don't want to waste their time. So you could look at their website. They'll have, I find more important than what they say is what they've invested in. So if you look at their portfolio, that's going to give you, frankly, all you need to know whether they would look at something like your type of company, because their investment style tells you a lot about what they actually take risk on, right? So Emma, tell us about your perspective. I know you see a lot of companies very early stage. What are those 3-4 things that you're looking for to say, aha, this is something I might want to pursue?
Honestly, definitely at the very beginning, what we give a lot of scrutiny on is the founders and the relevance to the problem they're solving. In many ways, we get a lot of, emails or applications where we see that they're so passionate about, a certain problem because it was exciting, because the market actually was hot at that time, and they decided to come together, and build that. To me, that is a long shot in many ways, because if you haven't at least interacted with that problem in one way or another, or if it's not you and you got a certain expertise, in fundraising, for example, but that other person at least have the leeway of accessing the market, having the network, understanding, the different business models that have been played, in that area. To me, that is the first thing that we would definitely look at. It's the relevance and the experience of the founders. And, how much really that they do before coming to us. Because I have an idea, and just an idea, and I'm talking to investors. I wouldn't recommend this unless you have that open relationship with some of these investors where you can go and explore possibilities and brainstorm. But if you're going to pitch your idea without prior homework of like the competitive landscape globally, regionally, what are the business models that have been done, before, what are the competitions, what is the expected, at least unit economics, in that part. And as Amjad said here, it's the homework is by going and seeing, the other companies, that have been invested in, and reaching out to founders is not really so difficult. There are many ways where you can access founders and ask about those basics. So I'd go and allude definitely on the founders and their commitments. So part-time founders, for us, is not something that we would want to also get into at an early stage, because I'm truly betting on these founders. If they have jobs, that means there is a cushion that they can always, mentally feel that I have a plan B. So the push towards, solving that problem, to me, doesn't go all the way 100%. So, which brings us maybe to another thing, outside this. You have to choose the right time to start the venture. If it's not the right time financially, family wise, so, and all of these, it has to be at least, the right time for you where you feel you're comfortable to actually go all the way, because the market is so competitive. The timing matters a lot, for the company. And there is so many business models or so many companies that are alike. Like I can bet you when we look at a certain, application, we see 10 of them in UAE, in Saudi, in Egypt at the same time. Everybody's solving the same problem. Right. So we need to look at all of those and decide the bet will go on this one, and why would it go in this one? So that goes again to the team and the incentives and all of these stuff. I think the second thing is basically, obviously, the fit, of and how really urgent is that problem, in the market, because there are sometimes good problems to solve, but not necessarily something that, that is really urgent at this stage where we see the demand of it, so let's say maybe in fintech, there's a change in regulations where allowed a certain, kind of law to pass, in that market. It's interesting to see which companies actually will be able to achieve and what is the winning outliers, that will make them get into it. And another thing that I always like to ask is about the defensibility. How do they think about defending their business models? How do they think about defending this product? What are they really looking at when they have started, thinking about it? And sometimes it's so early when it comes to us, and that's fine. But at least if we feel the coachability of the founders and they're able to listen, defend and push back. I love it when founders really push back and they say, this is the right thing to do. We've done this, we've done that, prove it and come back. So just feeling that, kind of problem, and it's fit obviously to the timing. And maybe the third thing is really who's going to build the tech. It's really like if you're outsourcing the technology, if you're getting a third party with no plan, in the long term, if there isn't a person internally who would decide, because technology goes a long time with the commercial side, right? You cannot think that giving it to a third party will take you to the next level or to take you to scale. As Tamer said, I want to see that scale and how would that team grow internally over the long term. So these are not very, very like different type of terms. I think this is the basics that any, VC would look at when they're looking at a company, and it doesn't make us any different by looking at this. Maybe another personal component that I would look at when we're talking about founders is our ability to communicate. There are different personalities. I may not be the perfect fit as an investor to you as a founder. And same goes a long way. Maybe that founder is not the right fit for us, because we would like to be able to talk, to actually communicate. I want to recommend you later on to other investors, and I want to feel proud, to pass you to other investors and say, I invested in that one. I believe in this founder, even if others did not invest, I see that they will be able to, go a long way after it. So I think that compatibility, if I may say, between the investors and their ability to believe, and that founder as well, it makes a lot of sense. And one last thing maybe to mention, a lot of the founders would say it's not an equal relationship between, because the founder is the one who goes and asks for the money. So they always feel that they are in a weaker position. And I think that's not the right mindset to start with. That is definitely not the right mindset. I love it when I feel that the founder is so, like, you have all the points, you have all the blocks. You're coming and saying, I'm putting this. It's an opportunity, right? And there are times where I feel I got to invest, like mentally, I'm in the call or I'm in the meeting, and I want to sound calm, throughout that time, and like continue asking questions. But deep inside, I feel I want it, it's like there is possibilities. I can connect them to this. I can do this. I can do that. So you want to remember, investors are people at the end of the day. They go through ups and downs. And as Tamer mentioned, you have our own pressures. Have we, fundraised? Have we closed the fund? What is next? What's my previous companies performing? So I'm looking for the next, win. And I want to be the one who bet on that one. And I want to make it so successful so other investors would also follow the money into it. So if you understand the psychology part of the investor, no matter what the conditions, as you mentioned, Amjad, that will be put on a website or seeing the companies, you will have a better style in communicating and accepting defeat if you were told a no. But maybe the next yes will come from that investor when they come to you, because they heard, your news or your updates or all of these stuff. So I feel, Tamer, you have something to say about this, but I'm not sure. But
No, I think you're spot on. I think you are totally spot on. I think that it's like, to distill it, and Emma addressed all these points, but it's like an analogy with a horse race, right? Is it the jockey? Is it the horse? Or is it the track? Right? And it's like, it's, the jockey is the team, and it's, the answer is like, it's some combination of those, but like, you're gonna try to, like, that's the way the investor, like, what is super strong? Is it the horse, right? Is it the actual business, the operations of the business, or the technology that's super, super unique that's going to make this thing win? Is it the track? Meaning the market is just it's so you can have the worst house on the block, but the property prices for the entire block have shot through the roof, and therefore the value of your house is shot through the roof, even though it's a crappy house. So is it that the market, your timing, and that's what I'm alluded to, is like timing, yes, in your personal life, and I totally agree. On your circumstances should be right prior to starting a company, but timing from a market standpoint, are you hitting it when you know that this market is going to pop? And then in which case it relieves the pressure to knock it out of the park on the horse. Like if the track is the fastest that it's ever been. Okay. So you want to sort of like, we're going to be looking at all three of those things. And it's hard to say which one is like the most important. I think the conventional answer is like, oh, the team is always the most important. And it probably is, but all of those things are important. I think there's a couple of like things, it's like rules of thumb that you should always keep in mind. And I think I'm also alluded to some of these, but number one is like, actually your conviction is what matters first. You're the one who's going to be building this business. And therefore, if you really are going to take it seriously and you want to raise venture capital, yeah, don't be moonlighting. Don't be like, be all in on the company first. Like it's going to put you in a bad position from a fundraising standpoint if you've got some other job going on at the same time that you want to raise money. It's just like straight up, like, don't do it. Number two, it's like, answer the question of like why. Be always pointing to why and not how. Meaning, what is it that gives you so much conviction about doing this? And because ultimately, if it shows as kind of like opportunistic, hey, there's a good chance that I can make a lot of money now, and we do see that a lot, right? And a lot of, like, when Emil says there's 10 companies that do, yeah, it tends to move in waves where a lot of people sort of they see something happening in another part of the world. Oh, that's going to come now. Well, that it's a good chance that that person is going to have a hard time explaining why they are doing it. And you really, and I think investors are really going to pay attention. Why is it that the thing that you're trying to do is important to you? And that's like a clear look through on is like the founder market fit the right thing. And then number three is like on the personal circumstances, yeah, it is a risk. And I think that's part of the, okay, yeah, you got to quit your job in order to start this company. And you should determine, am I in the right, like financial, do I have savings in order to support myself for 6 months or 12 months? Because I need to get this company a far, I need to invest into the company prior to going to the investors to get to raise money. And I think that we're evaluating, and there's other kind of like, red flags. I think that if you want like the most investors will apply a filter, and so Amjad was alluding to that correctly. Let's say we've set our criteria and we're going out and canvassing all over the world and talking to every accelerator and talking to every program and every Win fellowship and everything. And now we've got every fintech company from Morocco to Pakistan. We're going to do an initial filter, and that filter is going to have like certain criteria. Look at the Berkus method, BERKUS, for example. That it says like 5 things, 1 out of 10. Are they a 6? Are they a 6 here and a 7 here and a 3 here and a 2 here? So you're going to apply usually some sort of formulaic rubric to get you to the next filter. So if a VC looks at 100 companies, they're gonna narrow down and they're gonna filter 70 of them out. And are you going to be one of the 70 that gets filtered out, or are you going to be one of the 30 that gets filtered in which case they start taking a closer look? Check out different methods. That's not something that we need to talk about now, but it's fairly procedural in how venture investors are kind of evaluating a top of the funnel type of company.
And maybe add to this, think de-risking. So when investors, they're trying to de-risk, we know it's risky by nature. It has to be risky, or venture-backed companies has a huge risk. But they're trying to de-risk by understanding what are the elements and components that you've got as a company, as a founder, a founding team, and as a market, so you need to have at least the basic answers and a little bit of like evidence, that could start this company and get it to the next level, and what would make it really go to the third and fourth, stages, whatever that is. But I think understanding, also the rounds of financing that you will require is also another important thing, because not knowing what that business entails is also a big one. So, but again, think when people ask you, they're trying to de-risk. It's not about just doubt. Doubt is part of de-risking. I have to critique, you have to ask, you have to really poke, they always tell you they critique. Yeah, we're trying to poke whatever, we know what's perfect for you. We know it's your dream. We know it's your baby. We know you want it to succeed, but people are investing and they need the returns, right? We understand, we've seen companies that were written off, so it's not like an alien thing, but you learn as well. And the same goes for the founder. You need to learn when your conversations happen with the investors, what worked, what really actually took you to the next level of the conversation, what got them excited where the meeting of 15 minutes went on to 3 hours, right? And once you start nailing that, I think, this becomes an easier, I won't say easier maybe journey in reaching out to investors. And I've seen people that started to enjoy fundraising, and it's interesting how they can do it well, and others don't. I've seen awesome founders that say, I hate fundraising, but I have to do it, right? It's just about decoding, this whole process and really knowing how to go about it in a much more educated way. But not sure that everybody will love it, honestly.
Well, you better learn how to love it, because it's important if
do
you
it
are
well
looking
without love.
at your business. Yeah. I just want to, we have a lot of questions coming in. I just want to answer one that I've seen a bit, which is really what I would call the pre-VC stage. I think if you're at the ideation stage, or, before you even launch anything, I would say strongly that's probably not a venture stage. You're still at sort of talk to friends and family, try to get some money together, build some viable product to begin getting some movement. I think venture would like to see something there. They will not, I would say a lot of venture would not invest in sort of a business plan. Unless you're a serial entrepreneur who's done this 2-3 times, you've had, you know, more than one successful exit, you could probably raise money from venture. But X that, I think you need to talk to friends and family. You need to use your savings to build something at that early stage. There are some government programs, depending on what country you're in, that you should look at as well. But I would say venture is probably not the right stage at that level. So we've heard some critical things, right? We've heard team dedication, that you have to be dedicated to what you're doing. We heard a lot on scalability, right? And I want to make sure the audience understands this, which is, why is scalability important? Because at the end of the day, Damer and Emel, they're financiers. They want to make money. And it's easier to make money when something is big and can grow to be very large. If you're operating in a very small market, it's just very challenging for a venture capital investor to see that they can get their return, which is multiples on investment. I mean, when you're coming in at the seed level, you're looking for home runs, right? You're looking for those 10, 20, 30 X's, right? Those are the ones that really you're looking for. I'm curious, and we got this as a question, which I thought was a very good one. Have you seen patterns in the wins that you've had? Are there certain things that you've seen in these wins that you can articulate, that maybe people can latch onto and say, oh, okay, I'm going to try to do that? Have you seen any consistency in all the wins or trends?
Yeah, I think that that's, and I understand most of you are of either of Arab descent, or you're looking at some Arab markets, at least like peripherally for your company, either like primarily or peripherally. And so this won't be like foreign to you, but this region, I'm in Dubai, I'm in Riyadh, and we are, let's call it 450 million people across the, you know, Arab world, the countries that are predominantly Arabic speaking. And then if you throw in Turkey, you throw in Iran, it gets even, you know, it gets bigger if you throw it, but some of those are like impractical right now. Throw in Pakistan, it's another 225 million. Some people go all the way to Bangladesh, another 165 million. So you're like, you start looking at a big, large number of people. Just your total number of people that you could is really big. However, it's divided into like 20 individual markets that each of them by themselves are like insignificant, basically. With all due respect, like even Saudi Arabia, not big enough. 35 million, 40 million people, one of the highest GDP per capita in the world, absolutely killing it from an economic growth standpoint, not taking anything away from any country. Qatar, the highest GDP per capita. Wonderful. Egypt, some of the highest urban density in the planet. You could do really interesting things for that. None of these countries are interesting by themselves. Period. They're not. If a company can figure out how to sell to these idiosyncratic markets that have a lot of commonality, right? They have common language, they have common culture, they laugh at the same jokes, they're actually a convergence of what they like to do, the stuff they like to eat and what they like to watch. And so but the companies that are able to jump from country to country, which is very difficult, but the companies that are like, I've got a widget, when I say widget, I mean a thing, a product, a service, or whatever it is that I built, a website, whatever is the primary like thing that I'm selling. I've got a widget that I can sell here and sell in Saudi and sell in Qatar and sell in Kuwait and sell in Egypt. And I've also figured out how to like price it. I mean, these people pay more. And so I should charge them in this way. These people, like, more of them will buy, but I should charge them a little bit less, but I can have bigger volume and lower. So people that conceptually understand that I need to build my business so that it caters to a large number of people, as much of that 450 million as possible. Those are the ones that have won, period. Those are the ones that have won. That's Kareem, that's Katopi, that's it. That's InstaShop. That's the game. That's what's the Instacart. That's even that's hunger, all of the Telebat, all of the hunger station, you know, the delivery businesses that have done well. They've all been able to they've all figured out that souk that they've all been able to sell across multiple markets, and that's where like the wins have come from, and that's in our own portfolio included. So like that's the but there's a lot to it. It's not just like you just decide I'm going to sell. Like there's a lot of deconstruction to figure out like what business models and what founder, like how likely the founders are going to be able to do that. But that's the common, like, you know, if you take it, what's the characteristic? It's that the companies that have been able to sell across multiple markets are the ones that have done well.
Yeah, and I think to stress on that point, you know, I think what's important about what you're mentioning is, you know, it's very easy to move from New York to Florida to California in the U.S. What's important to understand in the Middle East is it's not that easy. So having that resilient founder who can figure out how to go from Saudi to Qatar to Egypt to Jordan to wherever in the region, you need that resiliency, right? You need that intellect, you need that resiliency. You need to be able to have a product that can be molded and fit in these different markets, which sometimes are alike, but sometimes can be drastically different. So I think it's a higher barrier in the region, but also makes it more exciting because not every company can do it, right? So when you find the one that can do it, it's really exciting. So,
maybe
sorry, Emma, go ahead.
No. It's actually complementing what you both said, you know, adding to that letter. What you're talking about, you know, here is also repeatability and ability to launch fast operationally and all of these stuff, which actually brings another layer, which was the metric of success, you know, for Careem at the beginning. It's reading customers correctly. Right. So not everyone knows how to assess the behavior of a consumer. They think what applies here applies there. Right. And you go on launch and then you're hit with all the other possibilities you didn't account for. And it's a famous one that Mudassir was talking about, you know, in Careem and most of his talks, and says, you know, even adjusting the note of addressing the promotion of Careem between Jeddah and Riyadh and like UAE, it was different in the narrative as well and the wording that were used. And that helped to onboard more customers and really speak to the minds of the consumers. So as much as we talk about customer discovery, we talk about the life of the company until even its exit. How much do they keep up really that depth of keeping monitoring, you know, what's happening in that market, and understand there's different way of sensing and reading your consumers and understanding their behavior and what they're about to do next when it comes to spending, when it comes to trends, when it comes to so many other stuff. But maybe another company worth mentioning, you know, Tabby recently, you know, with all the announcements, the ability to come in a time, in a very economical, you know, challenging, let's say, time where people needed to still keep up with their lives, you know, there comes a solution that unlocks this, right? So the product market fit and its ability to get that comes with connecting with the right partners, with the right financiers and all of these stuff. So how do you bring all these blocks together? It takes an orchestrator. It takes someone who sees what are the main important blocks, as Damer said at the beginning, you know, to go from one market to another. So I would definitely add the consumer understanding piece and the ability to get into different markets, because that is one of the biggest blocks besides operation when you're launching that company. And don't underestimate it. There's so much we say before entering that market. You as a founder need to go to that market. We've seen so many companies, they want to launch it out of Pakistan or out of UAE, and they want to be sitting in that country. No, you got to go there. You got to sit with people. You got to talk to them. You got to understand, you know, your market audience. And no matter what you see that as an investment, it is worth it of time, you know, at the very beginning. So, you know, what are the best, you know, and the first steps that you actually do. But really exciting, I think, to talk about successful models, and that can go on, I think, for hours to see what actually takes the company from one stage to another.
Yeah, luckily you both had some great wins, so we can definitely have another session to talk about those. I just want to remind the audience you can ask questions on askac.org. So that's askac.org in case you have a question. You hit on several things that are really interesting. You know, I think one is entering markets can be challenging. I'm just pitching you guys a bit here. in that investors can help, right? So I think having the right investor in that market can, what I found can be very helpful and valuable in helping you think through the market, helping you with introductions, network. For instance, if you want to go into the UAE, you want to go into Saudi, having an investor who understands that environment is really critical. I think two is this whole notion around, you know, the founder, right, and how good they are and how resilient they are. You know, I can't tell you how many conversations I've had with people where they're so secretive about their business model. They think that's where the unique value is. I can tell with confidence, no business model is unique these days. I mean, we've seen them all. What's unique is your capability and your take on that business model, and your capability to actually execute that business model. I mean, I'm sure you know, at any one time, we've seen 10 pitches of the same business model, but you back the one that you feel they're onto something. They have the right team, they have the right product, they're going to execute on this better than anyone else. And sometimes we've seen different VCs back different horses, by the way. So it really depends. I want to ask you, I'm a founder. I want to meet.
Can I jump?
Yeah, please. Please, Dan.
Can I just like jump on that? It's like, here's a like hypothetical. It's like on that, you're absolutely right. Like, don't be cagey with the story, right? And a lot of, I think people, it's like tactical for a lot of people. It's like, let me act like what I've got is precious, because that will like make the person that I'm talking to think that it's precious, you know? So it's like, it's more of a tactical thing than a need thing. But my typical reaction was like, okay, if you look these days, people have to know who you are to buy your stuff. Like if you're not transparent with like what you, especially with, like, we're just fresh off of COP just happened here in Dubai, really like incredible, impactful event where it's like makes you think a lot, but like you're moving in the direction where like every single input to your company is going to be traced for its carbon footprint. You know, it's one of the main themes of this thing. So the more and more the consumer audience, all of your like partners, all the banks that you work with, everybody is like going to want to know, open kimono, what's going on? Like, how do you operate? For KYC, you know, show me who, I want to know who everyone is and you know, how do you operate? So if you're like cagey with me, a potential investor, how on earth do you think you're going to sign up like customers or like partners or what? Like, it's less of a reflection of like the propriety. It's more of like, you clearly don't know what it's going to take to like build up this business. You're going to have to share a lot of information with a lot of people to get all these different components off the ground. So it's like, that's something to think about, is like, no, I'm sorry, if you think that you're able to like build a business that's going to scale at the level that we need you to scale by being non-transparent, then you're like, it actually reflects fundamentally on the mindset that you have in the business. And that's like,
I think part of it also,
yeah.
Tamer, is also lack of experience. I've seen that first-time founders, when they go, they think they should not be sharing. I've been offered NDAs in first meetings, and I apologized immediately that I never sign NDAs, you know, because you're going to be sharing a lot. And I'm not going to sign an NDA with every sentence, you know, that we actually share. And sometimes I've seen that founders were advised by this, you know, by lawyers, that non-startup lawyers, you know, so they have a lawyer that told them, you know, keep the information, don't share everything. They're going to take the ideas, they're going to share it with their portfolio. I've heard so much about that, right, during some of the meetings. And I think the best way also to tackle this is, you know, talk to founders that have succeeded in initial fundraising. And part of it, I say, try to talk to someone who just fundraised a close round to you. I mean, don't go to the one in D, because they forgot the pain of the pre-seed, right? Try to actually talk to someone who's close to the stage you are in, because they're just fresh out of it, you know, and they spoke to these investors, they know the questions, the right timing, while someone who raised 7 or 8 years ago, it was a different time, it was a different circumstances. So definitely be honest as well, because you hide and we go discover in an initial Google search. I've seen it a lot. Like, I've seen so much stuff that were posted online about the company or about the founder, and I would go and ask, you didn't share that with me. Why would I trust, you know, it's going to happen moving forward. So the world is so big and the network of founders is so small as well. As much as you think it's big, we ask one, they tell you the whole stories, about what's happening here, what's happening there. Same goes for investors. You go and ask one investor, you go and ask one founder about that investor, stories get shared. So definitely it's a world of transparency, and your execution, as Amjad said, it's what goes a long way. And there are many successful companies in the same field. They're all competing in similar markets. They're doing really well, each in its own way and realm, and they could be targeting same customers. Don't be surprised, like same customers use the multiple, apps at the same time, but they have a preference why they would go to this one at this time, why they would go to that one. So your job is to figure out what is unique about you and how you're going to add it moving forward. But definitely some of it comes with experience, I guess.
Yeah, and as you said, don't forget that we all talk. So VCs talk to each other all the time. So when you do this, you want to make sure that you're consistent, because they are talking. And frankly, some of them can even introduce you to other investors if they like the story. So keep that in mind. Before we go, very quickly, what is one advice about where to meet venture capitalists and how to get to them? Like, what would you suggest? And I know this could be very localized, maybe going to certain conferences, but very briefly, what would you suggest?
Yeah, I I'm glad that you asked that, because I was like almost gonna like put the little hand up myself to like ask the question. I get it. Like it's a tough one for us, right? Like I get it that this is like it's a long-term partnership, and it's a weird thing to like meet, and because it happens all the time. Amjad introduces us to someone. We meet them. What is the first? Why are we meeting them? Because that person is fundraising. That means the first time that I meet this person, they're asking to fundraise. And we do the same thing when we're fundraising for people. It's like, hey, an introduction was made to that, investor that we're pitching. And like, am I really going to sit down with this person and meet her for the first time and like ask her for money? Is that like, it's totally unnatural. It doesn't happen in anything else. Like, well, maybe it does, but I mean, it's like illogical. It's not tactically the best way to do it. And so it's like, but at the same time, I also know that, people don't have time to waste like just relationship building without make it like, I'm trying to raise money, and like, I need to talk to people who are interested in investing money. And that's that. I'm not going to take an hour-long meeting to just chit chat with someone to get to know them. So it's a tough one, because, what I'm going to say is that I actually suggest that you do, call on your network, always a warm intro, right? It's always like, don't like, you can try, it ain't going to work. So like cold call people, like, let me email 1,000, let me get a long list of investors and just blast emails to them and use Superhuman to personalize it that says, Dear Tamer, by the way, Superhuman is going to misspell my name 90% of the time. And so then I'm going to know it's like, this isn't a personalized email. It's just an automated blast. So salamu alaikum. But number two, it's like, if it's not a warm intro, it's just like low probability that it's going to convert. And there's a high probability it's going to actually make you look bad. So only warm intro. And I would actually suggest that the first time it's like an introduction of what you're doing. And it's actually an ask. You see what I've done, see who else we've invested into. Hey, I've got a question that's not for asking you for money. I actually have a different ask. I want you. I've got this other, like you guys have invested in this, and I've got this idea of how my thing works well with this thing. And I wanted to bounce that off of you. And maybe if you wouldn't mind making an introduction to them, or maybe running it by them, then it's like, wow, okay, cool. And actually that would go so it sort of like takes the pressure off of an immediate intro where it's like, okay, can I have money now? And and then it's like, that's what it's like. Otherwise, it's a sorry to be like going off piece, but it's like it's a meeting, and then it's a follow-up. Hey, do you have an answer on it? And it's like, no, I'm sorry, I don't have it. Most of the time, no, I don't have an answer, because like I need more time to like figure out who you are. So I actually think that tactically speaking, the best way to do it would be you do try to build a rapport, try to have some relationship. Don't be conscious about wasting people's time, but you try to have a relationship with the investor before. That will suggest an elevated strategic thinking about how you approach partnerships in general. So
yeah, I want to double down on that. I think one of the most important things, again, goes back to networking, is the more you network, the more you can get this soft introduction, because it helps, when someone makes an intro that they know well, it sort of takes down that first barrier. And I want to advocate what Tam is saying. I think we went through a phase of venture where deals were happening so fast and money was slushing around, where building relationships got lost. I would say we're back to the old days. Build a relationship, get to know people, let them get to know you, let them get to know your business. We like hearing about businesses, frankly, but be thoughtful, right? Like, don't waste time, but be thoughtful about how you approach and what you approach with. I want to give Emma the last word, so please.
No, I think my best ways of meeting founders is basically through founders intros. Those goes on the top of my list. Like, I can't even ignore an intro that comes from a founder, whether they're a portfolio company or not, by the way. So I've got few founders that sends me certain companies. Those goes at the top of everything. And I would reprioritize meetings to actually sit with those, especially if I know that founder and what they have done and built. And I would say it's interesting, and especially if they have put their own money, they angel invested. So I'm like more intrigued.
It's even better.
Yeah, exactly. I want to sit and see what are the possibilities. The second is obviously, if let's say Tamir or Amjad sent me, so anyone who's in my community that I trust, I would assume that the first layer of DD of like the business, the founders, that at least that initial one, I can trust that I'm talking to someone who's serious, who came through a good resource. So warm enters definitely goes a long way. And the third one, by the way, I've met founders in coffee shops, like just sitting and working, and I had 500 on the back of the laptop, and they would come, and those are the best sit downs. Like, come natural, introduce yourself, and you assess, is it the right time to sit and offer, can I speak? Do you have a minute? And it depends, honestly, what I'm doing at that time. But I can tell you tens of times I've sat with people I didn't know in a plane or in a lounge or in an airport or in a conference. It wasn't all in conferences. So, but it's how you approach, the person, and how you assess and be really empathetic about the states. If I'm running, to the plane and I'm like, it's not the right time. But if you come and you see me sitting and you can I have a chat? I've seen you, I've talked to you, whatever. At the end of the day, we're humans and we would love to hear the stories. So adopt the story narrative. What was unique? Are you that founder who's a second time? Are you that person who left this job because you found that need and whatever? So be careful about the narrative and the story you tell, and how to actually get them to the next, meeting. Your goal is the next meeting. Honestly, that's what I would say. Don't look further. Next sit down in a proper setup where I can come and bring the rest of my team and just have that sit down. So don't plan for the next 10 years, just have that next target. But yeah, it's really a good topic to talk about.
Well, with that,
yeah, in case you're wondering, Emma will be at Draft Coffee in Alaya from 4 to 6 p.m. on Thursday. She'll be the one with the 500 sticker on the back. So that's when you can go and just like interrupt her work.
It will be promotion. Yeah. Home Bakery is my spot in Riyadh. And I meet a lot.
We were actually going to post both of your addresses and phone numbers on the screen at the end. So they'll find
right on my door.
I need to figure out where you sit, Tamir, and send the founders to you and you may.
Well, look, I think note to the Atlantic Council next time. We need to make this 2-3 hours because this was amazing discussion. And I can't really thank you both enough. I chose you for a reason, and it paid off because you guys always are very straightforward. You come with a very humanistic approach. You've worked with great founders, and I know you're very generous. So thank you for your time. Thank you for your insight, and look forward to having you with us again.
Thank you so much. It's been a pleasure. And
thank you.
Being with awesome people. Thank you so much.
I'll punt it over to my wonderful colleague, Nebraska, to close us off. Thanks.
Thank you, Amjad. Thank you, everyone. I agree with Amjad. I could listen to this conversation for hours. I think 1 hour is not enough. Next time, we'll ask AC to do that for us. So thank you, everyone. Today, we heard from our esteemed panelists, Amal Dohan, Tamar Kadoumi, and Amjad Ahmed, who provided us guidance on how to navigate the venture capital system, from what the venture funding is to how to secure funding and how to approach investors in coffee shops. So thank you all for listening. And today I will want to carry on this momentum with some very important action items that was discussed through this conversation. The first one of the main themes we heard throughout this conversation was find the right fit. Conduct thorough research, whether from the economic unit, competition, the market, before you reach out to your investors, and figure out how your what you're trying to fundraise for aligns with the investor as well. We mentioned that there's criteria on their website. If you're fintech, there's fintech based ventures that specifically looks for that. The second one, craft a compelling case. We heard about how demonstrating commitment, being as a full-time founder, helps you elevate your case to the next level. The third one was cutting-edge technology. Nowadays, we all heard about AI and many other technologies. So we heard throughout this conversation the importance of having technology being integrated in your business and how the investors perceive that as well. The fourth one, the best way to reach out to investor, obviously, as Tamer mentioned, with a warm introduction, which goes along the way, other than the cold emailing. Have the founders connect you with someone they know. And this is what's one of the first few items, action items that we heard from both of our experts in the field to take as a founder to sort of take the next step on your venture funding stage. I want to take this moment to thank our sponsors, PepsiCo, the U.S. Embassy in Manama, the U.S. Mission to the UAE, and the U.S. Embassy in Saudi Arabia. Thank you all, and thank you for the Atlantic Council team for making this possible. Thank you.